In March 2023, Silicon Valley Bank lost $42 billion in a single day. Not to fraud, not to a cyber attack, not to some rogue trader in a back office making bad bets. It lost the money because people asked for it back. That's it. That's the whole story. Depositors wanted their deposits, and the bank didn't have them. Now, here's the part nobody says out loud. That's not a glitch in the system. That is the system. And once you understand how it actually works, you'll never look at a bank balance the same way again. Let's start with something you were probably taught at some point and then quietly forgot. When you deposit money into a bank, that money is no longer yours in the way you think it is. Legally, you've made a loan to the bank. You're a creditor. The bank owes you the money. It does not hold the money. There's a difference, and that difference is enormous. Banks take your deposit, keep a fraction of it on hand, and lend the rest out. This is called fractional reserve banking, and it's been the foundation of modern finance for centuries. In theory, it's elegant. In practice, it means the money in your account exists in two places at once. You believe you have it. Someone else is spending it. That's not a metaphor. That is the actual mechanical reality of your bank account right now. Here's where it gets stranger. When a bank makes a loan, it doesn't reach into a vault and hand over existing dollars. It creates new dollars, digitally, on the spot. The bank types a number into a ledger, and that number becomes real money, spendable money, money that ripples through the economy as if it had always existed. The Bank of England confirmed this in a 2014 research paper, quietly, without fanfare. Commercial banks, it said, create money in the act of lending, not the central bank, not the government, the bank sitting on your high street or the app on your phone. This is not a conspiracy theory. It is published institutional fact. So when banks talk about losing money, what they're often talking about is the collapse of a number that was created out of confidence, sustained by confidence, and destroyed the moment that confidence cracked. Now let's follow the math. When Silicon Valley Bank collapsed, it had around $175 billion in deposits. It had made bets, mostly on long-term US government bonds. That looked safe on paper. Then interest rates rose, fast. The value of those bonds fell. SVB was sitting on roughly $15 to $17 billion in unrealized losses. Losses it hadn't technically taken yet, because it hadn't sold the bonds yet. But then a rumor started, then a tweet, then a run. Depositors tried to pull $42 billion in a single day, and SVB couldn't produce it, because the system was never designed to produce it. Not all at once, not ever. The FDIC stepped in, the bank was seized, depositors were eventually made whole, not because the money was found, but because another institution, backed by public guarantees, absorbed the gap. The money that didn't exist was replaced by money that was created to replace it. Follow that logic to its end. Here's the uncomfortable part. Banks operate with something called leverage. It means they control far more in assets than they actually own. A bank might hold $1 of real capital for every $10, $15, or $20 it has lent out. This is legal. This is standard. This is encouraged. The incentive structure is almost perversely simple. When the leverage works, the profits are enormous, and they go to shareholders and executives. When the leverage fails, the losses are socialized, spread across depositors, taxpayers, and the broader economy. This isn't an accident. This is the architecture. And the reason it persists isn't corruption in the simple sense. It's something more systemic. Banks are too embedded in the plumbing of the economy to fail cleanly. A bank collapse doesn't just hurt shareholders. It freezes payroll accounts, halts business loans, disrupts the basic infrastructure of commerce. So governments protect them, not out of affection, but out of necessity. The bank knows this. The bank has always known this. Now contrast this with what banks tell you. They present themselves as safe, stable, boring even, a place to park your money while it earns a modest return. The imagery is marble lobbies and trust. The advertising is warmth and reliability. Meanwhile, in the background, the actual business model is borrow short, lend long, and hope the timeline never collides. Borrow short means taking deposits that customers can withdraw tomorrow. Lend long means making 30-year mortgages, multi-year corporate loans, decade-long infrastructure bets. The mismatch between those two timelines is where banks make their money. It's also where they die. when the short end panics and the long end can't be liquidated fast enough. Every bank that has ever failed has failed some version of this same way. The specifics change, the structure doesn't. The wider implication is this: we have built a global financial system on the organized, institutionalized creation of money that doesn't fully exist, backstopped by governments that can create more money that doesn't fully exist, monitored by regulators who understand the system well enough to manage it, but perhaps not well enough to ever fundamentally change it. This is not a system on the edge of collapse. It's a system that has demonstrated it can absorb enormous shocks, adapt, and continue. But each absorption leaves a residue: more debt, more guarantees, more moral hazard baked into the next cycle. The 2008 financial crisis led to bailouts. The bailouts led to a decade of cheap money. Cheap money led to asset bubbles. Asset bubbles led to rate hikes. Rate hikes exposed banks like SVB. SVB's failure led to emergency backstops. And the cycle continues, each iteration a little larger, the stakes a little higher, the interventions a little more extraordinary. So here's the question worth sitting with. If the money banks lose often didn't fully exist in the first place, and the money used to rescue them is created in response to the crisis, then what exactly is being lost and what exactly is being saved? The answer, if there is one, has less to do with money than with something harder to quantify: confidence, belief, the collective agreement that the numbers on the screen mean something. Banks are allowed to lose money that doesn't exist because the alternative, admitting how much of it doesn't exist, might cost us something far more difficult to replace.